Are you a global entrepreneur in a trading business? Maybe you are sourcing products from Asia to sell in US or Europe, and you feel like you are constantly watching your profits margin disappear. First, the wire transfer fees, then the terrible currency exchange rate, and finally, even though you may have already left your home country, this tax bill takes a huge part of what's left. Let's fix it. Hi, I'm Raymond, a licensed accountant and tax advisor based in Hong Kong, and I have helped hundreds of global entrepreneurs do exactly what I am about to show you. To make sure you get everything that you need, I am going to break this down for you. First, I will show you the simple re-invoicing structure that acts as a central hub for your global business. Second, I will explain how this structure can legally bring you corporate tax bill down to 0% using the Hong Kong's offshore exemptions. And finally, I will show you how this unlocks the modern multi-currency banking so you can stop losing money on the fees and conversions. Stick around to the end because I will also cover the most important questions you should be asking. Is it legal structure? We will discuss the critical personal tax risk like the CFC rules that you absolutely need to know about. Be sure you like this video, share, and subscribe my channel for more qualified tax advice and strategy, just like this. Now, let's dive in. Before we get to the solutions, let's talk about the frustrations. For most online entrepreneurs who trade physical products, the business model is simple, but you're probably facing two core frustrations that are killing your profits. The first is operational. You need to pay your suppliers in China, Vietnam, or India, often in their local currency. But when you try to send a wire transfer from your banks in US, Canada, Australia, or even Dubai if you're living there, it is a nightmare. The fees are high, the exchange rates are terrible, and the processing time are long and unpredictable. Worst of all, the banks often thread or box these transactions. They don't understand your business model and they see this as high risk. This slows down your entire supply chain and can damage your supply relationship. The second frustration is financial. Even if you get the money moving, you are getting eaten alive by costs. You lose 3 to 5% on currency conversions, another part on wire transfer, and after all that, the profits that finally land in your home country's bank accounts get hit with 30%, 40%, or even 50% corporate tax bill. So how to fix this? The key is to create a re-invoicing center in Hong Kong for all your international transactions. The idea is incredibly simple. It's to buy directly from your suppliers and sell directly to your customer with your new Hong Kong company. For example, your supplier in China sells products to your Hong Kong company. Then your Hong Kong company sells that same products to your end customer in US or Europe. The goods are still shipped directly from China to US. They never physically go to Hong Kong, but the invoice, the paper trail, and most importantly, the profits are now legally centralized inside the Hong Kong company. Except for sales and purchase, it is also very common to centralize the operational costs into Hong Kong company. While this is super easy to manage the cross-border payments with the Hong Kong banking system that you will see in the next point. So why so many of my clients are doing this? Of course, there are huge benefits. At least the structure can instantly solve those two frustrations we talked about. First, the operational chaos is gone. Your Hong Kong company can open a modern multi-currency business account with platforms like Wise, Airwallex, or other fintechs headquartered in Hong Kong. This is a game changer. Imagine your customer in Germany paying you in Europe directly into your Europe account using IBAN. Your customer in US can pay in US dollar to the local US dollar account. No wire transfer need. Then you can pay your Chinese supplier directly from the US dollar balance. No forced conversions, no terrible exchange rate, no hidden fees. Just clean, simple, and multi-currency cash flow. Now for the best part, the tax. Hong Kong operates on a territorial tax system. This is very simple. They only tax profits generated from activities inside Hong Kong. For the international trading business, Your activities are happening all over the world. You're finding supplier in China. You're negotiating with the buyers in US, and you, as a director, might be living in Thailand or Dubai. Because your core business operations, your buying, selling, and managing are all happened outside Hong Kong. You can apply for what's called offshore profits tax exemptions. When this is approved, your tax rate on these trading profits becomes 0%. It is not a loophole. It is a fundamental feature of Hong Kong tax law decided for the global business, just like yours. You solve your operational nightmare and your tax headache with one single elegant solution. Of course, as I mentioned many times in my videos, the offshore exemptions is a serious process. There are many steps to follow, and this is exactly what I helped my clients map out. If you want to do this in the right way and sleep well at night, book a consultation call with me to get a solution tailored specific for you. Now, the first questions everyone will ask, Raymond, this sounds too good to be true. Is this actually legal? Let's be clear on this. For the Hong Kong company itself, the answer is yes, 100%. The company is its own separate legal entity with the tax residency in Hong Kong. Getting 0% corporate tax on this profits under the offshore exemptions is completely legal and written into Hong Kong's tax law. The real issue and where the capacity comes in is your personal tax level. This becomes critical when you withdraw funds from your Hong Kong company as a salary or dividends. You have to consider the things like the CFC rules, CRS rule, or sometimes the transfer pricing as well, which all these rules apply internationally. The rules depends on your citizenship, your tax residency, and where you are physically living and operating the business. This is where it gets very complex and handled on a case-by-case basis. Remember, you are not just setting up a company. You are building a system that has to be compliant on a global level. So, if you are an international trader ready to set this up correctly, click the link in the descriptions to book that call with me and my team. I'm happy to review your situations, needs, and plan, then provide you the honest advice and solutions. I hope this video was helpful. If you want to learn more about opening the multi-currency bank accounts I mentioned, click these videos here. See you in the next one.